For mass market subs, can you give us a 30-second summary of your double-dip recession theme? Timely call in front of the recent pre-announcements to industrials. Sounds pretty ugly.
It is ugly. I mean, you can't. It's not that complicated, really. Maybe I'll give you a couple. I'll give you a little eye candy. Let's see what we got here. This deck gets so big, it's so thick. Got 80 slides in this thing. Josephine, just go to the double-dip recession cartoon. That might be a good spot to start. There you go. A little cartoon for you. Next slide. Global growth, is it bottoming? No. These are the trending revisions to the downside. All, as you've noted, most things that are officialdom have revised their growth forecast lower. Go forward a couple more. Inflation bottoming, no. PMI's bottoming, no. Let's go one more. Stylized model. Okay, right here. It's nothing actually that you haven't seen me doodle on the board before. So again, we use the stylized model again to just remind ourselves where we are. So you have early, mid, and late cycle. The cyclicals obviously peaked at the end of 2014 and effectively predicted this next slide, which are indeed that you get to see that this is the peak in the ISMs and industrial production growth. They peaked before GDP growth did. You see how those red lines went red. And the idea now is that while the ISM might be barely above 50, industrial production is negative year over year and falling still. So under the red, in the red is effectively a recession. Okay, I think everybody would agree with that. And if you don't agree with that, then come on over here and pay us oodles and doodles of money, and we'll help you understand that when something's protractively negative on a multi-quarter basis year over year, that's called a recession. Now go to the one more chart. Let's see here if we got anything else. Yeah. Now this is the damnedest of things. This is the longest non-recession losing streak ever for industrial production growth. So you go back to that chart before, slide 15, and you see how we're negative and negative remains negative. Go back to 16. So then you zoom out and you say, does this happen before? And actually the answer is no. The answer is that we call it it's the longest non-recession losing streak ever, because you're about to have a broader recession, i.e. a big gray bar. So that's actually the most convincing point, is that unless it's different this time, unless the economy starts accelerating in late cycle employment and consumption terms, which clearly I'm telling you we're about to enter on the employment side, the worst part of this let's just give you a little, this is going to be the labor market for the next 3 to 6 months. You're coming in here. And every big surprise, like the one we had in May where the Fed had to turn tail and go super dovish, remember that awful jobs report, that'll be more commonplace. And that's a problem. I mean, do you think that Hillary winning and ramping minimum wage nationally and the cost of doing business in this country and taxes is going to be a stimuli for job growth? I mean, even if it was, if you believe that it is, that the great government multipliers are going to fly us to the moon and back, for those of you who still want to go to the moon, which I don't. The reality is that it doesn't matter. You're going into the toughest part of the cycle from a comparative period, base effect period perspective, and that's the problem here. So we're going to be in this very slow to slowing faster economic scenario, and the industrial cyclical piece is not reviving itself. There's way too much supply. The back end of the deck goes through the whole supply scenario, and maybe we'll do that tomorrow if we get questions about it.